I have 4 mutual funds that have outperformed the S&P for 30 years as a group. Not hard to do. It's really not that tough to do.
Hey guys, what's going on? It is Kevin here, and I am back with a clip that a subscriber just sent me from a couple of days ago. This clip is super new, super fresh, and basically talks about Dave's four-fund portfolio and outperforming the S&P 500. So I thought I'd give you my opinion as a CFP professional. So let's go ahead, not waste any more time, and jump into this clip.
I'm aware of your recommendation to invest your money evenly in 4 funds: small cap, mid cap, large cap, and international. I also hear you guys regularly reference the average annual return of the S&P over the last 30 to 50 years. Can you provide some insight into how his investment protocol has performed compared to the S&P? If mimicking S&P performance is the key metric, why wouldn't he recommend just parking your money in an S&P index fund?
It's a great question.
That is an absolutely great question. Looks like it's from Dylan there from New Mexico. Very good question. Let's see what Dave has to say.
He, I assume, meaning Dave, per your recommendation for many, many years now. All right, so insight how this investment's performed compared to the S&P. Well, the small cap, mid cap, large cap, international, there's not a one fund that we can look at to compare to the S&P, but the S&P largely is a bunch of, mid cap and large cap companies, if you look at the makeup of that. So it's just not as diversified as what you're mentioning.
Exactly. So here's the thing. Individual mutual funds in the growth mutual fund sector, less than half of them beat the S&P. And that was the guy that started the Vanguard S&P Index Fund, Bogle. John Bogle was brilliant, and he discovered that. And so he came up with this idea of where you hear the phrase passive investing. That's where it first came from, where you don't have to worry about it. You just buy the S&P, screw it, because half the mutual funds don't even beat it. And those people that do that are passive investors.
Versus active.
Sometimes called Bogle heads, because John was actually onto something. His actual data was correct and is correct. To this day, half the growth stock mutual funds do not outperform the S&P. But that also means it's kind of like there's a 60% chance of rain. There's a 40% chance of sunshine. Hello.
Okay, so that is pretty misleading there. If we're looking actually at some recent, scorecards from, companies that actually measure and benchmark this stuff about active funds versus passive funds, it's really close to around 80% do not outperform the S&P 500 if that's what the equivalent benchmark was over a 1-year period. So Dave might be referring to that over a 1-year period, but again, why the heck would we look at a 1-year period? We're much more interested in knowing the 5, 10, 15, 20 plus year time period, not just if 1 year these active funds can outperform. But even for the 1 year, it's still very unlikely that the actively managed funds outperform their index benchmarks for the S&P.
So I have picked in the 4 categories 4 mutual funds that have outperformed their indexes. Now, the small cap, the index would be the Russell, because a small cap is not necessarily, it's more like an aggressive growth stock mutual fund, right? A mid cap would be like a growth. That's more like that's a typical growth mutual fund. Large cap, typical growth stock mutual fund. Like you said, the S&P is a mix of those two. And then obviously international, a foreign fund, that's a different index. Okay, so what I want to do is pick a fund that outperforms the no-brain way of doing it, the passive way of doing it. And so if I've got a mutual fund that for 35 years has outperformed the S&P, and it's a growth stock mutual fund, and I put that in my 4, I've got a small cap that's outperformed the Russell, and I put that in my 4, and so on. Well, guess what? The 4 of them as a group are going to outperform the group of indexes, unless they don't do as well as they did in the last 25 years, or whatever the number was of the history on the things.
So what Dave is basically saying there, and this is partly correct, which is you can't compare every fund to the S&P 500 because it's not the equivalent benchmark. So, certain funds should be compared to, say, like the Russell 2000, the Russell 1000. There's a ton of different benchmarks out there. So even though the S&P 500 is used a lot, it's not always the appropriate benchmark. But what he's claiming here is that he's actually picked specific mutual funds that have, outperformed that specific benchmark that they're supposed to be against. And then the portfolio as a whole has also outperformed the S&P 500. So again, that's a very bold claim to make. So I'm going to just keep letting him go here and see what else he says.
So my particular four mutual funds that most of my stuff is in, that has outperformed the indexes, has outperformed the S&P because I didn't pick one of them that didn't. That's why.
And the other piece of this that we're not factoring in is that international fund, which we recommend 25%. If you look at the S&P 500 and it's down in a given year, the international fund usually is up.
Yeah, it pretty much runs the inverse.
Okay, so international and say like an S&P 500 fund don't run inverse. If you're looking at an actually, broadly diversified international fund that shows a lot of countries in it, usually the correlation is around 0.8. So most of the time it's correlated, not inverse. What Dave might be referring to is like, say, a China-only ETF or a specific country ETF. Those correlations are much lower, maybe around 0.5, 0.35. So that's maybe what he's alluding to. But in general, international as a whole does not have an inverse relationship with the like the S&P 500. It's not true.
And so even in a given year, if the index, beat your mutual fund setup, you're not factoring in the long term of what could happen in the market.
But it never has. The four I picked has always outperformed the S&P every single year.
So if the average in the S&P is 10 to 12, you might be seeing 13, 14.
Yeah. I've not gotten 10 points more. Not,
it's not 20%.
And here's the thing. Let's go back on this too. It's very interesting. I mean, the way I'm doing it is actually mathematically beating it. So it does answer the guy's question.
Okay, before he goes here, I just have to say, if you're going to claim that your portfolio with the specific funds is outperforming their benchmarks, S&P 500, whatever it is, you have to tell us the exact tickers of those funds. It's not going to hurt anybody for these funds to, be known. These are probably well-known big funds anyways. It's not like it's going to create some chaos. So knowing those funds is very crucial to be able to actually, test what he's saying. Because if he doesn't tell it, it's just hard to believe as a certainty that it's accurate. So that's the annoying part is if you're not going to say it, then you really shouldn't be telling millions of people that you are outperforming the S&P 500,
But the problem with this discussion is always that somebody's having this hypothetical, if I had done this thing. And when we actually have figured out that people who invest in slightly substandard mutual funds way outperform those who never invest.
Or those who jump out, or those who are in single stocks.
Those who analyze everything to the point that they've got an anal problem with it, right? And it's like, you guys, would you shut up and invest? Because 100% of the people that invest end up with more money than those that don't.
Okay, so this is where Dave is really at his best. He's saying, hey, stop worrying so much about the small things in the bigger picture, because if you have somebody that's investing versus not investing, it's 100% true. You can't be, have analysis paralysis and you're just trying to figure out which fund you should buy if you're just not investing. That's bad. But the distinction here is that we can, as a, good investors, say, let's have an optimized, well-researched, route to invest in, and also be investing at the same time. So it doesn't have to be, one or the other, but if you are somebody who is not investing and overanalyzing everything, then Dave is absolutely correct on that side. And there probably are a lot of people out there like that. So he does have a point there.
Every time. And that's the number you need to concentrate on. And so
it's not mutual funds versus index funds.
If you actually do the index fund versus the person that believes what we believe and doesn't do anything, I'm on your side. I'm glad I got you to invest in something. Because if you just put money away, you'll have some money. It's magical. And so, like, for instance, as we studied all the millionaires we studied, most of them were not super sophisticated investors. They didn't spend a lot of time analyzing, like Dylan is, what this is and what I should do and da-da-da-da-da. There's not a lot of theoretical mumbo-jumbo.
They weren't prodigies. They were just average people.
I got a 401k at work, and I'm going to put some money in a growth stock mutual fund, and now I'm a millionaire. And that's exactly what they did. I mean, they really didn't. They picked out their mutual fund based on what the guy in the cubicle next to them was doing. They did not do some kind of sophisticated think tank analysis. But here's the trick. They did put money in investments. They didn't sit around and talk about it and not do it. That's the problem. So, the percentages all go out the window until you actually do it.
Yeah. Whether it's 12 or 13% doesn't matter if you have no money in the market.
So, all that to say, Dylan, I have 4 mutual funds that have outperformed the S&P for 30 years as a group. Not hard to do. It's really not that tough to do. You can have your SmartVestor Pro say, show me some mutual funds that have a 25-year track record of outperforming the S&P. They can do it. They're there.
So it's not hard necessarily to find funds that have outperformed the S&P 500 over a long time period. You are able to search for them and find them. The problem then is, are those same funds going to do as well as they've done going forward, especially when you consider, fees and taxes and things like that? And the answer to that is almost certainly no. And again, just because, we've had a very good, technology or growth sector doing well in the last decade, doesn't mean the next decades are going to look like that. So the previous winners may not be the forward-looking winners. And I guess the best way, like an analogy I could put it is, it's basically trying to say that when you had a bunch of starters for an NFL team or something, and then you're looking at them and saying, which of these is going to be in the NFL Hall of Fame? Well, it's easy to say that today when you know who's in the Hall of Fame, but back then, 30 years ago, you had a bunch of players, you didn't have a dang clue. So that's the problem we're running into here, is you really can't be saying that, especially if you're not going to tell us what the funds are, So just keep that in mind there.
Not all of them, less than half, but they're there, okay? And you can put that little portfolio together, and if it does what it did in the past, it will outperform the S&P. Mine have. But if you don't want to do that and you just want to put it in the S&P, you're going to end up with a lot of money.
We'll all end up rich.
And we'll be happy for you. We're not mad at you. But that's the answer to your overall question.
What a great nerdy discussion.
It is a fun
And by the way,
discussion.
you actually cover how to pick mutual funds in our Investing Essentials virtual event. We've got one coming up later this year. So if you guys want to learn more about that, you can sign up for updates at RamseySolutions.com/events. But that's where, if you want to nerd out like this, you're interested in this kind of conversation, you want to know how to build wealth the right way, in depth, we'll walk you through it in that event.
Yeah, the funny thing is, I would argue it's a lot more difficult and a lot more strenuous to go and try to pick out these actively managed funds. It would be easier just to own, these low-cost index funds that are going to do a lot of the work for you. And so again, it's interesting because they frame it as if the low-cost side and the passive side is the hard work, whereas the exact opposite. It's a lot easier, a lot more simple, and a lot less headaches and a lot less worrying and trying to pick and choose who's going to do well.
Yeah, but here's the thing. We have talked more people into putting money in their 401k and Roth IRAs than anybody in America, because we got them out of debt so that they could do it. And then they believed us, and so they went and did it.
It's a margin issue and a little bit of education.
And then there's some, not Dylan, but there's some, moron on the internet going, well, Dave Ramsey's created more poor people. No, he didn't. He got people to invest while you're sitting with your thumb in your ear.
You weren't listening very well if Dave Ramsey made you poor.
I mean,
that's pretty wild.
That's just, but they say, because he doesn't understand how. Yes, I do understand it, you idiot. Of course I understand it. But what I'm better at than you are is getting people to actually invest instead of discussing freaking theory. Theory doesn't matter until it's applied. I really don't care what you think about swinging a baseball bat until you swing one, honey. And then we'll talk about whether you can connect. That's how this works. You got a lot of theory going on out there. You got a lot of people that have an opinion out there that have no stinking money. It's all these life coaches that don't have a life. It's the same thing, And so, guys, just invest. Even if you do it wrong, you're doing it better than the moron who talks about it and never does it.
It's like a bunch of out-of-shape people talking about workout routines and which one's better. It's like,
yeah.
Great, let's go work out. How about
Arnold Schwarzenegger has created more fat people. No, he didn't. It's just dumb, okay? Seriously. But here's the trick. If you invest, you're going to have some money. Ooh.
And if you don't invest,
you're not going to have any money.
Yeah, so I really don't entirely disagree with that ending point there. You can't get so focused on one thing that you're, trying to do all these hypothetical scenarios and model everything out. And trust me, as a CFP, I love to model things out and see, how things are projected. But the main thing is you got to get invested. You have to actually swing that bat as Dave was saying. So, and that's where I think Dave really does shine, is he has that strong connection with someone. You pick someone off the street, they really just need to get into something, get invested, increase that contribution savings rate. Where Dave's already kind of falls apart is about, outperforming the S&P 500 over a long time period without providing the fund names, the active versus passive debate. So, he definitely is somewhere, he's got some good and some bad being said there. So as a prudent investor, which I'm assuming you are if you're watching this video, is you have to distinguish between those two, understand, both of those, and accept them as they are, because on YouTube you're going to get people on completely different spectrums, saying all this stuff out there, and it can be tough trying to sparse it all out. But yeah, that's all I have for today, guys. Hopefully you did enjoy this reaction video. If you are new around here, please go ahead and subscribe and hit the bell icon. But other than that, that's all that I have. Have a great day, and I'll catch you in the next video.